99% mortgages are not just risky for buyers, but they're also risky for our economy and our financial systems.
What are 99% mortgages?
A 99% mortgage is where you have a very, very small deposit. So that's the amount you put down when you buy a house, just 1% of the value of the home. And then you are borrowing 99% from the bank, and that's known as loan to value. So that is the loan to value ratio of the price of the house.
Why are they risky for buyers?
A 99% high loan to value mortgage is really risky. I cannot overstate how risky these products can be. If house prices fall and you've borrowed a lot against your home, you are more exposed to what's called negative equity, which is where the loan you took out is bigger than the value of the property. So you actually owe the bank money.
How could 99% mortgages impact the financial system?
99% mortgages are not just risky for buyers who, as I just explained, are exposed to house price falls and also interest rate rises. I should have mentioned that. If you've borrowed a lot and your mortgage is really big and interest rates go up, that interest is being charged on an absolutely whopping loan, whereas someone who's borrowed less, interest rates go up. But they're also risky for our economy and our financial systems. I don't know if you remember 2008, but the global economy crashed. And that was because of what we call subprime mortgages, which are dodgy mortgages where people who shouldn't really have been given loans are given loans, or people were allowed to borrow much more than they could really afford to repay. Lending criteria have been tightened up since 2008, but we actually haven't really had widespread 99% or 100% mortgages since 2008. And there is a reason for that, because these loans are risky. And if the economy takes a turn, which we can all agree it currently is, it could be really, really bad news for the banks.
How will the 99% mortgages impact house prices?
It's difficult to say how 99% mortgages would actually impact house prices, because my big question is how many banks would actually take up this idea, and then how many people would get approved for the mortgages. So I think it would really depend on whether the product was viable and banks were going to sign it off. We don't know that. They might look at it and think, do you know what, this is too risky. But let's assume that they did, and that lots of people started taking out 99% mortgages, which, by the way, I think is very unlikely. What it could do is create a bit of a frenzy in the housing market, which could drive up house prices temporarily. Now, house prices are gently falling in most parts of the country. And if house prices were inflated, there is a real risk that you create a bit of a bubble, because the reason house prices are falling is because simply they're not affordable. And we always knew that. We always knew house prices has got too high. It's known as asset price inflation. I think the question is, people were just waiting to see what would happen. And what happened is interest rates rose because of inflation, and house prices started gently coming down because people then couldn't afford mortgages. So buying a house was very difficult. And I do worry if you suddenly unlock this quite risky credit and you inflate house prices a bit more, and then something else happens somewhere in the world, then house prices fall and lots of people who took out massive mortgages are in negative equity. And I have to say, by the way, I am in negative equity. I feel really strongly about this. I used a government scheme, Help to Buy. I bought a flat. It's worth around £25,000 than when I bought it. And that means, because I'm remortgaging at the moment, I have to pay the bank a percentage of the negative equity. So the consequences are very real.